Your overseas bank account, the one sitting quietly in the UK, Australia, or Canada, already has your Thai address on file. And your home country's tax authority has already received a full report. Your balance, your interest, your dividends, and exactly how much money moved through that account. No warrant, no audit trigger, no warning. 100 countries, exchanging financial account data automatically, right now. That is not a future policy. That is not a pilot program. That is the CRS, the Common Reporting Standard. And if you live in Thailand as a tax resident, you are already inside it. Thailand is not just receiving reports on your overseas accounts. It is sending reports on your Thai bank accounts, your Bangkok bank balance, your Capricorn savings, to HMRC, the ATO, the CRA, and the tax offices of every other participating country. The data flow runs both directions, and most expats in Thailand have no idea this web already exists around them. Here is why that matters for your personal finances. If you're a tax resident of Thailand, meaning you spend 180 days or more in Thailand in a calendar year, you are legally required to file a Thai personal income tax return the moment your assessable income crosses 120,000 baht per year. That is roughly $3,300 annually. If you are remitting money from overseas to cover rent, food, or anything else in Thailand, you crossed that threshold long ago. And the tax rates are not trivial. Thailand's personal income tax runs from 5% at the bottom to 35% on income above 5 million baht per year. For a digital nomad remitting $50,000 annually, a completely typical figure, we are talking about a potential Thai tax liability in the range of $5,000 to $10,000 per year, depending on your deductions and allowances. That is real money, and CRS means the Revenue Department now has the data infrastructure to find it. There is a second layer here that is worth pausing on. This is not just Thailand watching you, your home country tax office is also watching. If you live in Thailand, remit money here but still file a UK or Australian tax return, CRS means both governments now hold overlapping data. Any inconsistency between what you declared to HMRC and what your Thai bank account shows is no longer hidden behind a border. The pincer closes from both sides. CRS as the Common Reporting Standard was developed by the OECD in 2014, modelled on the earlier US FATCA framework. The core idea is straightforward. Financial institutions in every participating country identify account holders who are tax residents of other countries, compile their account details, and send that information directly to that person's home country tax authority once a year, automatically. The data is not a flag or a summary, it is a detailed financial dossier. 8 categories of information sent government to government. Your full name, your tax identification number, your date of birth, your account number, your year-end balance, all interest credited, all dividends received, and gross proceeds from any asset sales processed through the account. If you have a Barclays account in London and a Thai address on file, Barclays has already sent that package to HMRC, with your Thai residency noted. Over 100 jurisdictions have now signed the OECD's Multilateral Competent Authority Agreement that underpins CRS. That list includes the UK, Australia, Canada, every EU member state, Singapore, and the UAE. It covers the home countries of the vast majority of Western expats currently living in Thailand. Now here is the mechanism that makes CRS genuinely consequential for Thailand-based expats, rather than just a background compliance detail. On the 1st of January 2024, the Thai Revenue Department issued Instruction POR 161-2566. This single instruction eliminated a loophole that expats had relied on for decades. Previously, the rule was simple. Foreign-sourced income only became taxable in Thailand if you remitted it in the same calendar year it was earned. So if you earned income in 2023 and waited until 2024 to transfer it to Thailand, it was legally outside Thai tax reach. That loophole is now closed. Any foreign-sourced income you remit to Thailand in the same year you earn it is fully assessable Thai income. Full stop. Before this change, CRS was uncomfortable but manageable. After this change, CRS becomes the enforcement mechanism for a new tax liability that did not exist in the same form 2 years ago. The Revenue Department now has the legal framework to tax your foreign remittances, and CRS gives them the data infrastructure to verify that you have complied. Those two things together, the rule change and the data exchange, are the pincer. Either one alone was manageable. Together, they fundamentally change the compliance calculus for every expat in Thailand who remits foreign income. What does this mean for someone living in Thailand right now? Start with the basics. If you spend 180 days or more in Thailand in a calendar year, you are a Thai tax resident. That is not tied to your visa type. A DTV holder, a retirement visa holder, an LTR visa holder, residency for tax purposes is determined by days on the ground, not the stamp in your passport. Run a concrete scenario. You earn $60,000 from freelance work or investments abroad. You remit it all to Thailand to fund your life here. After standard personal allowances and deductions, your estimated Thai tax liability sits at roughly $8,000 or more. Under the old loophole, that was avoidable with timing. Under POR 161-2566, with CRS running in the background, it is your legal obligation, and the data to verify it has already been exchanged. Smart expats are doing 3 things right now. First, they are getting a Thai tax identification number, a TIN, and filing a PND 90 return before enforcement begins in earnest. Second, they are consulting a Thai tax advisor who understands the interaction between CRS, POR 161/2566, and any double taxation agreement their home country holds with Thailand. Third, they are auditing exactly which financial institutions hold their accounts and what address, Thai or home country, those institutions have on file, because that determines which direction the CRS report travels. Thailand has active double taxation agreements with many countries, including the UK, Australia, the United States, and Germany. These agreements can reduce or eliminate double taxation, but they do not eliminate the filing obligation. You still need to file. The DTA only applies once you have declared the income. Here is the single thing to carry out of this video. CRS is not coming. It is here. The data has already been exchanged. Your overseas accounts have already been reported to your home government, and your Thai accounts have already been reported back. The question is no longer whether this system sees you. The question is whether your tax filings, in Thailand and at home, reflect what that system already knows. If you are a Thai tax resident remitting foreign income and you have not filed a Thai tax return, 2025 and 2026 are the window. Not because the rules are new, they are not. Because the enforcement infrastructure is now in place to match those rules against reality. For a deeper breakdown of how POR 161/2566 interacts with specific visa categories, which double taxation agreements apply to your situation, and exactly how to file a Thai PND 90 return as a foreigner, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com and subscribe to this channel so you get the next one.